Good morning, everybody. Welcome to our session today. The agenda I've got is on the screen, and it's going to just talk about some things that might be of interest as you get ready to begin a new year. Today, we're going to focus on talking a little bit about the synchronization between control and accounting software. Talk about the performance of estimates, managing estimates, the accounts receivable performance, just different things that are more administrative or management focused. And then on Thursday, we'll change things and talk more from a profitability standpoint. Now, a couple of things that I draw your attention to. One is that what steps a business owner will take at as they go from one calendar year or fiscal year to the next from a planning perspective will vary tremendously. So based on that kind of reality, so to speak, a lot of the things that I'm going to comment on and share really reflect my personal experience. So it's don't interpret what I say, what I talk about as being a hard, fast must do. It's certainly not the case. The other thing that I want to just bring to your attention is that there is a handout that I don't think it got posted yet, but there will be a handout that's a single document. And it will apply both to the discussion today as well as on Thursday. And then the last thing is just a heads up that may or may not happen. I discovered a little bit ago that my AirPods that I'm using for speaking were not firmly plugged in. So it's a possibility that I will lose audio on those. And if I do, just hang tight with me. I will switch over from the talking through the computer to I'll call in and then I'll use my phone. But I'd rather go as far as I can with the AirPods simply because of the quality of the audio. So with that said, I'm going to switch now so that we're looking at control. And everybody should be seeing control, right, Linda?
We are. Yes, we are.
All right. Okay. So the information in some of the key reports is really what I want to talk about. From a control and perhaps from an accounting perspective. So the synchronization between control and QuickBooks or your accounting software, whether it's QuickBooks or Peachtree or whatever, the process within control is all driven off of the quick reports. So I'm just selecting it. And some of the reports that I think are important, if you come down on the left-hand side, where you see prior closeouts. There are 3 reports in there that can get generated, okay? And it's a financial summary, it's a payments report, and it's a sales report. Now I'm going to preview these, and I'm going to illustrate it by choosing a prior closeout. And in my data, it's going to make more sense that I do that from prior closeouts, and I'm going to choose prior export closeouts. If you're doing all of your closes based on a daily close, then that would be the one that you would want to choose. And I'm just going to choose the number 3, and then I'll do a preview. I'm not going to go into any kind of details on these, but just more of a frame of reference. So what it's showing on the sales side, these are the transactions and the total amounts. Nothing earth-shattering, but these might be helpful And whether you're looking at it for a month, you're looking at it for the whole year, it depends on how deep you're looking at the information. The other other report is payments. I've chosen just a daily closeout. If you do this for a longer period of time, this report can get extremely long. Again, if you're just doing it for a certain period, then this can be very helpful in making sure that you've got everything accounted for in your accounting system. And then lastly is the financial summary. And again, I've chosen a prior closeout from June of 18 to March of 19. You can see that for testing purposes, I don't do very many closes. But this report here, I consider to be one of the more important out of control, for the very simple reason that most everything, in fact, everything that is going to be needed in the accounting system is reflected on this. On the asset side is the net change in money that you've collected, the net change in accounts receivable. Highly unlikely that any of the WIP or any of these will ever be exported. I don't think in all the years that I've been around this, I don't think I've ever encountered anybody that wanted to do that. On the liability side, the deposit or the credits, the customer deposits, and probably the most important are the taxes. And again, orders due rarely, if ever, is going to be carried forward. Down on the income, on the P&L side, a list of all of the sales by the product category that they belong to. Now, if you're bringing that into your accounting software on a one-to-one basis, obviously the total should match, but then you may need to go back and look at individual ones to make sure. That's going to help you detect whether or not there's has been an omission. Okay, so this particular set of reports, I think, are very helpful in using those on a frequent basis. Now, one other report that's really important, again, dealing with the synchronization, is up under reports, financial, closeouts, and then slide clear to the bottom. And then again, I'm going to go down to the date and choose the same one that I did before. Prior closeouts, prior export, number 3 in preview. What this report is showing is this reflects every closeout that's going to go to your accounting system. So if you're exporting to QuickBooks, each pair of lines, the blue and the white, each pair of lines reflect an export or a closeout. So the data then flowing across here is what should show up in your accounting software. The WIP will not, the bill will not, the sales, you'll see the sales come over. You'll see the taxes come over. Nothing will flow from an orders due standpoint. The net change in ARs, payments, deposits, the credits, and all of these will all flow forward from your accounting system or from control to your accounting software. Now, I don't have anything from an accounting standpoint that I can show you that as far as what would come in on the into the accounting software. So some of the things that I think are important steps to take is knowing what it is that actually flows across, from control to your accounting software. And on the asset side or in the balance sheet side, it's payments. Generally, they're going to flow from control to your accounting software to an account called undeposited funds, generally. A few may take that directly to the checking account, but generally it's going to flow through to the undeposited funds. And then when those funds are for a particular day have actually cleared, then there will be a deposit or a transfer out of undeposited funds to the checking account. So there's generally one account on the balance sheet side for assets, and there's one account that will flow that deals with the accounts receivable. Again, the net receivable is just a positive number or it's a negative number. The actual customer view of the accounts receivable is always going to be maintained in control. So in any given day, the receivables is either going to increase or it's going to decrease. So it's a positive or a negative number, and that's the value that's going to flow to to the accounting system. On the balance sheet again, but on the liability side, you'll likely have one or more tax accounts, probably state, probably county, maybe city, maybe multiple counties. You're going to have deposits that you've taken, so that if you write up a new order and you collect a deposit in whole or in part, that money is going to flow into the bank, but it's also going to be treated as a liability as a deposit that was taken. And then if you grant customer credits. So those are the critical ones that are going to flow from control into the accounting system. There may be some manual credits, but not likely. On the income side, in your P&L side, as I said earlier, I think that depends on how you want that mapping to occur between control and your accounting system. It could be just as simple as a grand total of sales that flows across as one sales value. Typically, I see a one-to-one relationship between, if you got 15 accounts on the control side, you're going to see the same 15 accounts on the accounting side. That it's more detail, but it also makes finding discrepancies a little bit easier, rather than have to look at the grand total only. So there may be one account, there may be 15 or 16 accounts on the income side. On the expense side in the P&L, obviously write-offs are going to show there. So the bad debt write-off. So how often should the synchronization between control and your accounting system be done? My personal view is at least monthly, preferably even a little bit more frequently that, and then it depends on how often you're doing a closeout in control. Some do it every single business day, Monday through Friday. So in that case, then doing a sync, making sure that you're in sync would be best to do pretty much on a weekly basis. If you're only doing a closeout in control on a weekly basis, then you could probably get by with making sure that you stay in sync on a monthly basis. Now, I stress that for the simple reason that the further you go out without monitoring or verifying that control and your accounting software in sync, the more difficult it's going to be to find where the error is. If you're using QuickBooks, for example, QuickBooks cannot tell whether you've skipped one. QuickBooks can't tell whether you've duplicated an import. So the further you get away from knowing when you last synchronized, the harder it's going to be to find an error, okay? I'm going to pause here to see if we have any questions or comments before I move on to the talk about some of the performance things related to estimates. All right.
No questions.
All right, good. All right, now I'm going to go back to the quick reports again, and I'm going to choose it because there's a category that probably is in your system, but it may not necessarily, and that is the estimate analysis item over here on the left. These are the reports that I think are the most valuable. I'm going to generate those. I'm going to use, since my database is limited, I'm going to use all for the date. And kind of work backwards. This report is helpful to know which estimates were generated and which ones that you deliberately marked as voided. And then you're going to see it's going to show the reason, okay? Which ones were rejected, and kind of the definition of rejected is that the customer told you we're not going to go forward with this project. You may have lost it because of price. You may have lost it because they went to a competitor. They may have, you may have lost it because they just simply decided not to do it. This one is a list of the estimates that are still in a pending status. So these would be the ones that you're continuing to monitor and communicating with the customer to see when they anticipate making a decision. So these are the ones that you want to work on. The next one is converted. These are the ones that you want to make sure that this is the path that follows. You want to generate the estimate and you want it to convert. I'm going to go back to the best one of all because it's short and sweet. This simply shows that for the period that you're looking at, who all generated estimates, how many were generated, what the total value is, the average, preferably how many of those were converted based on a percentage, how many were lost, and how many were voided. So you can see that for each person that is generating estimates, as well as the total. Now, the significance of this, when we get into talking about some action steps, is keeping track of knowing how many you're generating, knowing what your conversion ratio is, and setting as a goal that you want to improve that conversion ratio, and steps that you can take from a monitoring of estimates, and then just pushing that process to make sure that there's adequate follow-up. So how do you monitor and improve the conversion ratio? The most sophisticated way is to adopt and have some control queries and macros that would run perhaps on a weekly basis, and they would send a reminder email. Those queries could, or the macro could send a query to the customer as a reminder. It could put an activity on the salesperson that wrote up the estimate. It could put that for follow-up. And then any kind of management related reports, that might be appropriate. And if you don't do the automated approach, then you're just simply going to have to rely on a more manual process that could include, just simple old telephone calls, to monitor, to monitor progress on each individual estimate. So the key there is that you want to review the number of estimates written and you want to relate that to those that are getting converted and see what that ratio is. And you want that ratio to be as high as you possibly can. So from a goal standpoint, know where you are, say for last year. Say, all right, we want to improve, try to improve that ratio by 1 or 2 or 3% in terms of the number of estimates that you write up, as well as the percentage of those that you get converted. And then obviously diminish the ratio that you lost to a competitor probably, or that you just deliberately marked that you avoided it. You're not going to pursue it any longer. Another good stopping point to see if we have any questions on the estimate and estimate management.
No questions.
Again, I stress that these are representing more my views and how I tried to do this in when I was in business. Now, the next topic is similar, and that's the AR side of things. So from a control standpoint, the simplest view is the financial summary. I'm going to do that. There it is. Again, just from a very, very high level, you're going to find out what your AR levels on the financial summary, in the balance sheet, and accounts receivable. Similarly, if you go to your accounting system, you should see the accounts receivable balance in there. Okay. Now, there are a couple of other reports that are helpful. Customers and receivables, AR reports. There's a summary and a detail. The summary report represents one line per customer where there is an AR balance, and it simply shows the buckets, for the aging, current, up to 30, 60, 90, and over 90. The detail, I personally relied on it because it took it down by customer to the invoice level, so I could see the aging on individual orders. Now, within control, also in the quick reports, down here is accounts receivable group, and it generates 3 different ones. The way this one is set up, the summary that I talked about, the detail, which is at the customer and order level, and then if you have multiple generating orders and being responsible for monitoring the AR collection, then it will take it down to the salesperson level. So all of these are potentially helpful in managing the AR balance. Now, again, my own personal experience, when I had my shop, I held each salesperson responsible for the follow-up and collection of ARs. So things that you can do as far as management of the ARs is the ratio. I'm going to keep talking ratios, okay? So you want to know what your current AR balance is on a monthly or so basis, and or look at it for the entire year, see what's outstanding at the end of the year, and you want to compare that to the total sales. That's the AR ratio. The lower that value or that percentage is, the better job you're doing managing ARs. So your goal is to know where you are right now, say at the end of 2019, and set a goal for the business that we want that ratio to be at or under a certain percentage that's better than what it was for the prior year. So that's your goal, to get that down. And then obviously the priority for managing ARs is the oldest, or that represent the more important ones. So over 90, between 60 and 90, but also look at the magnitude. So if you've got a sizable job order that's several $1,000s, so it's a high dollar volume, then that probably would take a higher priority to to manage. Now, steps that you can take to help with this, again, you can do it either on a manual basis, where each salesperson perhaps, or a person designated to oversee and follow up on ARs would do that on a manual basis, just using reports. Or you could automate some of that process, through queries in a macro. Any comments or questions on the AR side? Nothing particularly earth-shattering, except that the managing ARs is critical. You simply do not want a customer to operate on your money. You've made the investment in the time, in the people, in the cost, and now the burden should fall back on them to fulfill their obligation of paying you in a timely fashion. Another breaking point for before I get into the next topic.
No questions.
All righty. This one is again, it's more on the sales view side. So I'm going to come up to quick reports again. And down in the sales analysis, there's really two different categories here. One is the sales analysis and the sales distribution. So on the analysis side, there's 3 or 4 reports that I think that are important here. And that's the ones that are listed. Out of this group, I probably would focus on the calendar month, the discount one, promotions. There's a pair of them here, and then your estimate conversion. So these are the ones that out of this group, I would probably pay more attention to the calendar month distribution, discount, promotions, probably on picked up orders, and then your estimate ratios, which we've already talked about. The other group that is in what's termed sales distribution, and again, there's probably out of that set here, there's probably 5 or so that I would consider to be the more important ones. We pretty much already talked about the calendar month. So the next 2, the volume and the frequency. In other words, you want as many repeat orders as you possibly can. So that's the frequency side. You also want to focus on the high volume folks, okay? And you're going to find that those two go together. So oftentimes your high volume customers hopefully will also be represent the ones that are the most frequently placing orders. It's one thing to have have a big order that only happens one time, but it's better to have multiple that may be smaller in value, but cumulatively represent a high level of customer connection. Okay. Another one depends on how good you are, so to speak, in capturing the industry that a customer belongs to. We tried to do that because we generated a calendar so that we had a pretty good idea of what the various industries, what their peak period was or month was for placing orders. Product category, these kind of go together, product category and product detail. The best overall view is the category, and then you may want to go deeper and know what specific products that customers are buying. I didn't really comment at all on the origin or the zip code. These are also good reports, particularly the zip code. If you're going to do directed promotional activities aimed at a specific area around your business. The origin, not so much. The origin by customers, how did they come to you for the first time? And the origin by order is how did they come to you for this particular order on an order by order basis. So kind of the action steps that I would consider would be, again, set sales growth goals, set goals to increase the frequency, and more importantly or equally important is the average value of an order. You always want the frequency to increase, and you want the or the number of orders to increase, as well as the order value. You might increase the order value goal 5%, 10%, whatever is appropriate and whatever is reasonable. Then you want to also look at the order for the products that you're selling that represent the highest margin, gross margin. And that, if you look at the estimated cost, the reports and control that show the value as well as the estimated cost, the ones that represent the highest margin would represent a good target for you to pursue. Discounts. As a business owner, I monitored discounting extensively. I looked at it every single week because I didn't want to see a lot of discretionary discounting take place. We set expectations that based on the value of the order or perhaps on the customer, that we wanted to restrict discounting that was arbitrary, that was random. And if I observed discounting, because I looked at the discounting reports, if I saw some that I perceived to be too generous, then I would sit down with the salesperson and find out why. I also set goals for if a discount was going to be in excess of a certain percentage, that they would come to me and say, hey, for us to be competitive on this particular job or project, would it be okay to agree to a higher level of discount? So I stayed active in managing the discounts. Also fall into the promotion bucket. So if you're doing if you're using the promotion as a means of discounting that applies to the entire order, those are the ones that are the most important. And monitor your promotions to see which ones represented the best return. And if there are ones that were kind of questionable as far as what they brought in form of new business, then I would probably not repeat those. We're running ahead of time, so we're going to have plenty of time for discussion afterwards. The last thing I wanted to comment on was the workflow. Well, let me come back to the gross margin. I created a group here that was intended to help me keep track of the gross margins, you know, the estimated versus actual, and then the estimated by order, the summary and by order. So I created an actual group in Quick Reports that would help me focus on the gross margin question, so that I could keep track of you know, where we were in terms of orders and gross margin. Workflow. This one, as far as the reports that are in control in the Quick Reports area, are very basic, very, very basic. The whole idea of these reports, in my opinion, is to make sure that you're getting when a job is finished, that the job reflect the correct status. In other words, move it along in the life cycle from WIP to built, and even the stations within each of those statuses. But more importantly, when a job is done and delivered or picked up or installed, make sure that the status is correctly reflected. You can do that with these. We did this pretty much on a weekly basis to make sure that things were properly reflected. Don't lose sight of the fact that there is the cloud production app can take this far beyond what the individual reports will do. Because now with the cloud app and your production people or your installation people, they can use a mobile device, a phone, an iPad, or whatever, from within the shop or from out in the field, without having to have access to control itself. They can move a job, a line item within a job. They can move it along in the production life cycle. They can do the same thing at the job or at the order level, move it along. So the value of the cloud app, I think, is the bigger the shop in terms of number of people that are involved, or the sales level. The importance of that cloud app grows as your business becomes larger and larger and larger. You're going to reach a point where it's going to be more and more difficult to manage the production process on a more basic level. Now, I've covered everything that I wanted, and I'm hoping that we can just have some general conversation, comments, experiences that you all have that could, we could share with everybody. So let's just open it up to to discussion from here on out, and hopefully we'll have some. Any questions? Linda, are you there?
Yeah, I am. No
Okay. I was
questions.
afraid that I had lost audio and didn't see it.
Oh, no, no. No questions so far.
Well, I don't want to keep everybody. I've covered what I want. On Thursday, we will resume again, and the topic will be a little bit different. But again, it's just some thoughts on as you get well into the planning for the new year.
And Paul, the handout will be available on Thursday. Is that what you're
Okay,
planning?
yeah, that's fine. There's more. The only the first page was relevant for discussion today, but the
Okay.
bulk of the handout is pertains to Thursday's discussion.
Okay. So that'll be
I will
available on Thursday. Okay.
Just as a heads up, I will be traveling. We're leaving tomorrow, so I'll be doing the Thursday session from Arizona, where we'll be with my laptop. So there shouldn't be any issues at all. But I will be traveling. Take care, everybody.
And if you can't attend on Thursday, but need the handout, please email Sirius or consulting@sirius.com and we'll get you the handout.
All right. Take care,
All right.
everybody.
Thank you.
Have a great day.
All right. Bye. Thanks, Paul.